Welcome to the Cordier Commodity Report, where James Cordier breaks down what's really driving gold, silver, oil, and the global economy. We'll go beyond the noise to explain the cycles, data, and signals behind major commodity moves. Hola, I'm Joe Pardavila. Let's get started. Hello, James. How are you, sir?
Joe, I'm doing better. Much warmer here than last time we spoke. It's no longer snowing and no longer people wearing large parkas, which looks so weird down the streets of Tampa. And now everyone's got their, their regular dress outfits on. And every once in a while there's a t-shirt and slaps. I don't own any of those, but they look more like Florida again. So it's great.
Well, it's great to hear that Florida is back to normal, but things around what we're going to discuss today are not. James, the markets feel unstable right now. Volatility, geopolitics, inflation, interest rates. When conditions feel this unsettled, outside of the weather in Central Florida, what should serious investors focus on instead of reacting to all of this noise?
For those investors that are in real assets, that's what people are starting to call commodities again. There's simply so much going on right now. I've been in this industry for over 3 decades, and I've never seen anything like this. It is, in my opinion, for the first time since I've been, trading commodities, people are finding this as a new alternative, a real asset, and the headlines just don't stop. I mean, it was tariffs the middle of last year. Now it's what's going to go on at the Federal Reserve and what are interest rates going to do, the value of the dollar. What's going on in Japan right now is quite interesting with their currency. And of course, you have the U.S. Navy steaming towards the Persian Gulf. That's always interesting for energy prices. And you have the on again, off again talks of war or not a little bit further east than that. So just practically everything you can throw at the markets, including the kitchen sink, is happening right now. And it certainly is a volatile, exciting period of time, especially if in fact you're one step ahead of the volatility. And certainly that's not always easy to do, but some people can do it. And when they can, this is a great place to be.
And so when people hear the word commodities, many think speculation or short-term trades. These markets sit at the center of everyday life. Why do commodities matter so much for understanding what is happening in the economy?
I don't know where the comment King Copper came from, but that's been in the industry for quite some time. I'll watch CNBC and they're saying, King Copper. And basically what this is doing is following certain commodities like lumber, copper, and oil. It will give a lot of investors, whether you're investing in commodities or if you're in equities, following these 2 or 3 markets gives you a very good idea of the underlying strength of the economy. Copper prices, when they are going up, generally speaking, end users who build appliances and homes and cars and batteries, they can foresee economic development much better than the average person just following along at home. Copper goes into practically everything. Lumber is followed shortly after that. And then of course there's energy prices. When these are going up, generally speaking, you're looking at a strong economy, especially in the US, 3 to 6 to 9 months out. It's been a great barometer.
And so do commodities tend to reflect reality faster than stocks or headlines? Because I think for most people that are from the sort of traditional investor side, they know one little thing or one thing that president might say may flip things on its head, and you see things trending in a direction one way or the other. When it comes to commodities, do they reflect these things that are happening on the outside faster than stocks or headlines?
I think they do. End users who are purchasing silver for connectivity, copper, as I mentioned a little while ago, for anything from cars to homes to manufacturing of all sorts. That is where the rubber hits the road, is the value of copper and how much demand and how much supply is there going to be. There's so many more dynamics when you're following equities. For example, you can be in the AI space and there might be 10 great companies, and lo and behold, one or two might not go the rest of the way as the other group does. And the dynamics there are very interesting. Copper does one thing, silver does one thing, crude oil does one thing. And there's end users that create huge amounts of volume for the trading of those commodities, unlike, in my opinion, securities, which I think have a whole lot of push and pull from different directions. And sometimes it's difficult to decipher which way they're going.
Hmm. Let's play the AI thread a little bit because it's funny. Jensen Huang and Nvidia gets a lot of attention these days because they have these chips that the AI machines need to be built and all that jazz. But the funny thing was that wasn't his intent. Like he built GPUs for gaming devices, and you saw how quickly a company like Nvidia just changed overnight. They were successful in that GPU space. Then all of a sudden, someone woke up in the world of AI and said, like, "Hey, you know what? Those GPU things, those are really good for AI." So you saw the shift there. When it comes to shifts in the way you were describing about commodities and AI, are there some sort of ripple effects in terms of like AI stock pricing goes up, venture capital goes in? Does that affect commodities? Are there certain commodities that you think will see a almost like a connective tissue to what's going on in AI?
The copper market and the silver market, absolutely. As we understand what a build out means and how much of these raw commodities are needed for the build out, absolutely. As AI becomes more realistic and less of a dream, and I think that's already happened, but to what extent, I think we're just finding that out now. Copper and silver are going to ride the AI boom, I think, for probably the next 3 to 5 years. And that should probably put a very strong floor under those two markets.
James, do people realize that commodities are the foundation underneath many of these technological shifts? Because, I mean, you broke it down very succinctly and very simply that, yes, the AI, LLMs, all that stuff that people are talking about constantly ad nauseum, at the end of the day, you still need those tools to create these platforms. Are people aware of how commodities play a role here?
I think trading NVIDIA and Apple and Microsoft, I think that's kind of come to the forefront. You don't have to study the production of the Peruvian mine that just opened, creating copper. That seems like much too much digging for a lot of investors. You just assume that commodities can be available, just place a phone call. We need, 10% more copper than we thought we did. Just make a phone call. It'll come out of the mines of Arizona, no problem. That's not how it works. When that call comes that they need 10% more copper, copper mines don't go up that fast, and they certainly can't increase production overnight with that phone call. And when you get that phone call, you'll see the price of copper double or triple based on that new demand until the extra supply comes in. So it's quite interesting that way.
There is some sweat equity involved in a lot of these commodities because I remember speaking to like oil people last year when Trump was saying drill baby drill, and then these are oil people who like the sound of that, but they know in practice we can't just flip a switch and start drilling oil. There's a lot of like sweat equity that goes into these things. So how much of that, and almost like the patience you talk about, like this patience of like, yes, all of these tools are valuable. Obviously, oil is, but like you can't just flip a switch one day, and be like, hey, we struck some oil. Let's go ahead and start drilling. It's not as easy as it sounds.
Joe, that excellent point. Exploration in the Permian Basin in West Texas and eastern New Mexico, that's just been going. I'm not sure there's any more land to put some holes in some of these areas, and this is the most fertile ground in the country. If we might increase U.S. production 500,000 barrels over the next year or two, I think that would be more than we can actually expect. The situation is this: oil trading at $55 and $60. That's not a big boom for new drilling and new exploration. If crude oil, we know it's going to be at 70 or 75. Now we can invest some money. Now we can increase production, but the landscape simply isn't there for that to happen. And we expect the crude oil production here in the United States, yes, the largest producer in the world, but to add, markedly more oil production, we simply don't see that happen anytime soon.
Hmm. Let's get the I word here. Inflation. People keep talking about it. Some people say it's going away. Some people say it's here to stay. Do commodities drive inflation, or do they reflect inflation that's already underway? Is it a chicken the egg thing here, James?
Commodities increasing in price does develop the inflation. Um, the price of raw goods like soybeans or sugar or coffee or cocoa, they don't watch, an inflation report come out at 9:30 in the morning in New York on one day and say, well, inflation's up. I guess we can raise our prices. It is the other way around. Uh, Coffee prices are up. I know a lot of people are talking about beef and eggs this past year. Those are up in price, and those are raw commodities that do uh, signal or count the inflation rate that's developing. And of course, when you talk about inflation, there's housing and the price of automobiles and things like that. But primarily, people look centered at commodity values. And when they're up, that is inflationary, and that is where a lot of the calculation comes from.
You mentioned the Federal Reserve, and it's funny. You've been in this game longer, James, but I'm trying to think like at what point in my life has there been so much trauma around the Federal Reserve? It's almost like it needs its own reality show. But how do commodities tend to respond when the Federal Reserve hikes rates versus when the Fed starts cutting rates? Let's cut through the drama of what's actually happening in DC. But like, how do those two things affect commodities?
Lowering interest rates, especially when the economy is doing fairly well. And right now, the U.S. economy is doing fairly well. If you look at the stock market, they think it's doing great. Stocks reaching all-time highs here recently. Lowering interest rates generally will devalue the price of the U.S. dollar. All commodities are priced in dollars. And when interest rates come down, you're going to see these main commodities, gold, silver, crude oil, soybeans, increase in value. And when they're raising rates, obviously they're trying to fight inflation, trying to tap down prices. And of course, raising rates slows the economy. So that's always the battle, raising rates to calm down inflation. We do have an election coming up in November. And any fight against inflation, we think, is going to have to take a back seat, because right now, I think the current administration is certainly looking at November and would like the economy humming along as fast as it can prior to then. And perhaps we worry about inflation after November.
So if someone looks at commodities for inflation protection, do certain sectors behave differently than others when you're thinking about inflation protection?
Interestingly, the different commodities do different things. We know what orange juice does. It's great in the morning or with a mimosa. Soybeans turn into tofu. That's protein. Corn is fed to cattle and chicken and hogs. And coffee, we know what that is. It feels really good in the morning. There's one commodity that spans all the other commodities as far as a hedge against inflation, and that is the yellow, shiny metal. Gold takes all these things into consideration. And when inflation looks like it's going to continue or even strengthen and going higher, people flood into gold. And so people are certainly looking for some inflation to continue going on in 2026 and 2027. If they weren't, gold prices wouldn't be at $5,000 an ounce like they have been recently.
James, why do commodities not move as one group the way many investors expect?
Interestingly, Joe, when you're in the equities industry and your 401k is loaded with different stocks and in different sectors in the stock market, generally speaking, all stocks go up or all stocks go down in the same direction. And commodities, the 12 or 14 that we follow, they have specific fundamentals of supply and demand, and they don't go the same direction. If you look at the price of corn or wheat, two of the main staples of commodities in the world. You can't do without these two. They're both in bear markets. They have a massive amount of oversupply. The U.S. farmers are the best in the world, unfortunately. That means more supply, and without more poultry, pork, or beef to feed these two, we simply don't need extra corn or extra wheat or extra soybeans. One thing that's been in the news recently is the price of beef. Well, the U.S. cattle herd is at a 75-year low. So we don't need as much corn as we grew 5 years ago, 10 years ago, 15 years ago, because while, corn tastes great at the county fair, that's less than 1% of what corn actually is used for. It's animal feed, of course.
Wow. And it's funny, you mentioned the fact that we have so much wheat, the farmers are doing a great job. How come there is no correlation then to grocery prices going down? If we are in such living in a world of abundance when it comes to some of these commodities, or is it just like you mentioned, it's too nuanced to just be as simple as like, we got a whole lot of wheat, so prices should go down?
No, they should go down. We got a whole lot of wheat. Wheat inventories worldwide are at some of their largest in history. The price of bread and the price of cornflakes and the price of Wheaties, they should be down. I know quite often they'll say, well, you do realize that, 20 cents of this loaf of bread is actually wheat. Well, it's the main ingredient. Turn over the package, bleached wheat, whole wheat. I'm not quite sure why, when those commodities are down, the price of cereal or bread or pasta isn't down. They should be. I think that the makers of these commodities that we're talking about, or rather these foods that we're talking about, I think they're doing quite well right now because the price is way down, and chances are the price at the shelf have not come down. That'd be my guess.
Hey, James, by the phrase, it's like the math isn't mathing right now because it seems so like you and I just shooting the shit talking about this stuff seems so simple, yet there's probably someone at one of these major conglomerates are like, okay, cool. Yeah, we have a lot of wheat. We have more of that. We can lower the price. But you know what? If we keep the prices up, that means our margins will go up. I mean, I want to say there's a conspiracy going around here, James, but the math is not mathing.
It's not mathing. The math is making them money, and I guess that's why they got in the business in the first place.
Yeah. Let's talk about future markets. They sound abstract to many people. Who uses futures in real life, and what problems are they trying to solve?
Futures are the ones that the investment in commodities that move extremely fast. And why do they do that? It's because they're using some 20-to-1 leverage. So, Joe, we hear about the commodities moving very fast. Copper recently made all-time highs. Silver this past year went up like 150%. If you couple that with leverage, the moves that have made people a lot of money in the past 24 months and have lost people a lot of money, it's just such a rapid investment. We started using options years ago, and that is our favorite vehicle of choice to get involved in this space. Who uses futures? Hedgers do. If you are Outback Steakhouse and you see the price of beef go down, you probably want to put on some hedges because this market has done nothing but go up. I think it was 3 or 4 months ago, the administration was going to tackle high beef prices, and the price fell like dramatically, like straight down. That was a great buying opportunity because as much as the administration wants to lower beef prices, you just can't make more beef overnight. Interestingly, how you're going to solve the beef production problem is by holding 30% of the herd back. And that brings more beef tonnage, if you will, to the market in 18 months. But in the meantime, you're taking supply off. So anyone looking for or hoping for lower beef prices, that ain't happening. It's not going to happen anytime soon.
Let me ask you something off book here, because you hear a lot of politicians, when the election cycle comes up and you talk about there's going to be one in November, and you make this example of beef, right? So politicians will inevitably come November, and they did last November and November before that. They're like, we are going to bring down the price of beef. Help me out here, James. How can the politicians, bureaucrats, people in DC, what can they like actually do, literally do, that can help bring down the price of beef? Because the way you describe it is like there's no magic wand. If there's X amount of cows that are producing this beef, there's no way to lower the price. So what are they saying when they're on the stone saying that we're going to bring down the price of beef?
They don't know much about it. Because, Joe, the U.S. cattle herd's at a 75-year low, and I'm not a perfect historian by any means, but I'm quite sure that the U.S. population wasn't at 350 million people 75 years ago. It's probably closer to 100. So you've got 3 times the people eating the beef that they did 75 years ago, and we're trying to make good with the same supply that we had way back then. There is no solving this. Beef prices are going to be high for the foreseeable future, and anyone saying that they're going to bring the price down, they don't understand the industry, is the fact of the matter.
So to be clear, and this is a not political thing, this is either party. When someone is saying that, a politician is saying that, you're telling me here that there's absolutely nothing politicians can do that would affect the price.
Joe, when it comes to investing, I am Switzerland. I don't have a political affiliation when it comes to investing. And I'm telling you that unless the people of Argentina are going to give up their entire herd and start packing them up on ships and selling them up to Texas, anything short of that, high prices are what they are. They're not coming down anytime soon.
Cool. Well, thank you very much, Switzerland. All right. So you talk about the hedgers. Let's get into hedgers and speculators. Why do markets need both of those parties?
Joe, trading commodities all began with the hedger. You know, 50, 60, 70 years ago, the states of Illinois, Iowa, and Indiana are planting corn, and Nebraska's planting corn and soybeans to feed the world. And what would often happen is when they're planting corn or they're planting soybeans in early spring, the price may go up slightly, it may go down slightly. But during those 6 months of planting corn in April and May and then harvesting it in October and November, if the price of corn reaches a particular level, that the banker who loaned the farmer the money and the farmer sees, well, I raised corn for $2.50, it's worth $3. I can actually sell my production that I won't have until October, lock that in, and I will live to make a little bit of money, get a new tractor for next year. The kids get to go down to Orlando on vacation, and we get to do it all over again. That's hedging. You're selling futures markets at a price that you see that is favorable and lucrative for your farm, and then you try and do it again the next year. That's where commodity trading came from, is the hedger needing a way to lock in prices, hopefully at a very good profit. Tropicana hedges orange juice. Outback Steakhouse tries to hedge beef prices. Battery companies, homes, they hedge, developers of this, they try and hedge copper prices. Copper was some 30-40% below where it is right now. That was a great hedge. If you saw this AI boom coming that's going to need a lot of copper, all you had to do is take a look at that and say, wait a minute, all this copper usage is going to be new. This isn't just simply going into pipes for homes and cars. And boy, that just doing a little bit of homework in this industry, it's like all this sounds like Chinese. It's not. It's extremely straightforward. And just thinking ahead a little bit can help investors and traders do this for themselves if they like.
All right, so I get the supply and demand when we you mentioned it, like we talked about like the beef and the wheat and oil, but I was thinking about, like, is there a supply demand component to gold? Like, because is there like endless amounts of gold in the world? Like, tell me about like supply and demand when it comes to gold. Just because the elements seem pretty obvious, geopolitical reasons, weather. We've talked about weather in the past, James. But like, what affects the supply demand quotient of for gold?
Gold production has increased about 1 or 2% annually for the last several years. So the supply is practically stagnant. So when central banks or investors or people wanting to cash in their dollars for a hard asset, there's practically nowhere, there's no big supply to tap into. And thus the price simply goes up. And then people who were, long from $3,000 or $4,000, someone's trying to buy their gold for 5,500. Well, at that price, you can have some. So it's basically the same gold being traded. And as investors don't want to sell and central banks continue buying, it only has one direction to go because there isn't any new supply of gold. 1 or 2% increase from year to year, and demand has increased 5 or 10%. Now that math does work, unlike the bread that we were talking about before.
Is gold and maybe silver, are they the only commodities that are sort of in that bucket of just the fact that you just can't make any more, or year to year you're not making any more than you did the year before? Are there any other commodities that have a similar kind of sort of trend in that direction?
No,
No.
those two are very specific. Platinum, kind of a cousin of gold, kind of a niece or nephew of silver. Platinum falls into that category, but it is very specific for its usage. Generally speaking, people who are hedging inflation are not buying platinum. It's just a white metal. It looks the same as silver, so it doesn't have that going for it. I have a jeweler friend in Wisconsin, and he said, you would think that people would race into platinum. It's less than half the price of gold. People just love gold, and they're used to it. They love holding it in their hands and wearing it around their neck. And look at the people of India. Just gold is like, it's like walking and chewing gum. And United States, friends here watching football. They have to have gold. They buy a certain amount each year, and it's insatiable, practically, no matter what the price is.
And because since you know so much about this gold, have we scoured the globe? Like, are there any places you think that are out there that like there could be gold at yonder, or is it basically like almost like we talked about the oil earlier? Like where there's oil, we know it, we know where it is. We know we can put a few holes in there, we'll get it. But is gold pretty much and again that sort of that stagnation why it only goes up 1 or 2% because we basically tapped out on where we can get gold from.
Joe, at $5,000 an ounce, people are looking. People are looking, and people are drilling, and the rich veins, of out west the United States, of South Africa, parts of Russia, some of the Eastern Bloc nations, Australia. Anywhere that they can find gold that has rich veins right now has been located, and there aren't any new ones coming up anytime soon.
Thanks for making me feel like less than idiot. You're like, yeah, for $5,000, I think they're gonna look for it. But I appreciate you. You're very kind, James. So how does the U.S. dollar influence commodities, especially gold and the aforementioned oil? Like, what is? Tell me the 1 + 1 = 2. Let's get the math right here. How does the U.S. dollar influence commodities?
For whatever reason, all commodities are priced in U.S. dollars, not won, not rubles, not yen. It's in the U.S. dollar. So as interest rates come down, perhaps this coming year, that would put some downward pressure on the U.S. dollar. And it's just simple math that the conversion, creates a higher price of gold or crude oil or silver or soybeans because they're all priced in dollars. So when interest rates come down, the U.S. dollar value usually comes down, and that's that spikes these prices to a certain extent, and that's more inflation, kind of like what we were talking about here just a little bit ago.
So interest rates do play a big part because of the dollar, right? Just because they're intertwined and it's not coming from anywhere else. It's basically like where it's riding its own wave is essentially here.
The correlation is perfectly direct. It's one happens, the next responds to it.
All right, awesome. Sorry, in closing, James, what is one misconception about commodities you wish investors would move past right now? You speak very frankly, even though you are the Switzerland when it comes to politics. But in terms of misconceptions about commodities, what do you wish, like, wave that Cordier magic wand? What do you want them to move past right now?
I would move past the idea of the leverage is too much or the speed is too fast or it's just so difficult to understand. Uh, just small amount of reading, a small amount of digging in for someone's self. Investors out there that, I saw the price of coffee went up or gold's at all-time highs. Just do a little bit of research. You can figure it out yourself. It is not that complicated. What I would do, however, is utilize very slow-moving option structures to get involved with commodities. That's the only caveat there is futures move awfully fast. They have a lot of leverage. Commodity options can as well. But generally speaking, it will allow your analysis that you work so hard on to figure out where you think the price of oil is going to go or orange juice. Slows down the market and gives your investment thesis a chance to work. That would be my advice to people considering commodities.
Awesome, James. Always a blast catching up with you. Always nice of you to be nice to me because, obviously I don't know anywhere as near as much as you do in this world. And you're just so kind. I really appreciate that about you. Looking forward to our next chat. That's going to do it for this week's Cordier Commodity Report. James, thanks so much. I will see you next time.
Thank you, Joe. It's always a pleasure.